Hi everyone, Chad Shoop here, and welcome to my latest edition of Bank It or Tank It. This week I'm going to be breaking down a popular stock that I'm sure pretty much everyone uses, and if you haven't used it, then I know that you've heard of it. It's Facebook, and this stock is always caught up in some sort of drama, and it's fluctuating up and down, but it's definitely one of the companies that has benefited over the economic lockdowns that we were in, and as the whole economy is slow to open back up, Facebook is a stock that's going to continue to thrive. So today we're going to be following our Bank It or Tank It analysis by taking a look at the fundamentals, the sentiment, and the technicals to figure out if this is a stock that we want to bank or tank over the next 12 months. Now, before we dive into all of the details for Facebook, take a moment, scroll right below the video and click subscribe so that way you don't miss out on any of my upcoming insights, any of my quick takes, my trade it videos, or my Bank It or Tank It videos. So just click subscribe and be sure to leave me a comment below. All of these companies that I want to feature are from comments that I find on our YouTube website or that you mentioned on Twitter at Chad Shoop Guru. So if you just leave me comments with stocks that you want me to take a look at, I add them to my spreadsheet and I continue to update them, feature them in my quick takes, feature them in these Bank It or Tank It videos. So just be sure to leave me a comment below and let me know what stock you want me to take a look at next. So for today, we're breaking down Facebook, and this is a stock that's caught up in even more drama right now with a boycott going on, and they're always under issues against how they're handling ads and advertisers that are coming to their network. What kind of content are they allowed to post? Twitter is another company always caught up in this kind of feedback. They're blocking certain tweets, but then they're allowing other tweets, and just really what's going into their data set, and the regulators are coming for them. They're looking to implement some sort of policy on these companies. But when we step back and look at what these social media platforms offer, what Facebook is doing right now and connecting people all around the world, it's really one of the only things left in the economy right now for people to go to enjoy and to interact and to socialize. I mean, I know my kids, they've really strung to the Xbox platform where they're playing online with their friends, playing video games because they're chatting and they're socializing. But for different generations, they're using Facebook or they're using Twitter to interact, because this is the mainstream of content that we're seeing at the moment with media platforms, the traditional TV model. We have no sports entertainment. We have no new shows coming out. All the big movies, everything's kind of put on hold. So our main forms of entertainment right now are YouTube, Twitter, and Facebook. And these companies, they really charge you nothing for the content that you receive. This video is absolutely free. You just log into YouTube and you get to watch it. The same with the content posted to Facebook and Twitter. How they make money and how Facebook has thrived over the years is they charge for companies to place ads on their platform. And more importantly, the ads that they get to place, they can be specifically targeting certain demographics, certain types, certain likes that you have on Facebook based on your profile. So they can be very specific and well more efficient than what you would see on a normal TV ad. So that's Facebook's really strong suit right there. And with the boycott coming up here for the month of July that we're in, they're going to receive a little bit of a hit here on their ad networks because, well, everybody's boycotting them. A lot of companies have pulled the plug on advertising on Facebook, but I really think that enough other companies are going to step in to fill that void and to continue to help Facebook drive higher. So today we're going to look at the fundamentals, the sentiment, and the technicals to figure out if this is a stock that we want to bank on. And we'll start with the fundamentals of Facebook by taking a look at their key stats. Now this is a chart of the revenues and net income. The revenues are going to be the blue bars on the chart, and the key for that's on the right hand side. And then our net income's the line on the chart, and the key for that's on the left hand side. So the first thing that stands out to me is this has a clear uptrend here from start. The chart starts on the bottom on the left and then just continues to consistently climb higher to the top right. And again, this is solely driven by ad revenue. So this is a company that's really figured it out. They're thriving in this market. You can see 2016, 17, 18, just consistent increases there for both the bottom line and revenues. So we're seeing strong demand to advertise on this platform. 2019, revenues continue to climb. Net income took a little bit of a step back, and part of that is because Facebook's ad revenue is their sole focus at the moment. They have their hand in other areas too, like virtual reality with their Oculus headset, and I think that's going to be huge in the future. But when we're looking at over the next 12 months, Oculus is not really going to be a game changer in that time frame for the fundamentals that we're looking at in the company. So while the net income took a dip in 2019, you can see that it's just barely ticks back up in the 2020 in the estimate and in the actual results for March. And revenue didn't go up too high either. So they're seeing a big jump here in 2021 on revenues again, and it continues into 2022. And I really wonder if that is factoring in at this point the pandemic that we've seen. And I would argue and say that it is, because they've seen strong demand throughout this pandemic. They've continued to see increases in advertising. The only problem that I see that could hit them is that basically the economy went through a recession, and what we're seeing, even part of this boycott, what it really means is that these companies are just cutting back on spending for advertising. So it's really more about the softness in the economy right now. And as that turns around, which seems to be the case, as long as we don't shut down the economy again, things are starting to open back up and really starting to pick back up with economic growth. And that's going to boost more companies to be confident to spend on advertising and to continue to pump money into Facebook. So I think that these revenue lines, while it's going to be a little volatile to get there, but I think the 2021 expectations are going to be in line with what Facebook sees. So this is a chart where the fundamentals are just really sound and looks great just taking this quick look. Now let's take a look at a few comparable companies to see how Facebook stacks up. So you can see some of the stocks here, Twitter, Google, because, well, they really rely on a lot of advertising as well. They run the ad networks, and then some other different social media companies, but not as famous as Twitter. But you can see with the market cap, this just gives you a perspective. 647 billion is Facebook's market cap. Only one company on the list is bigger, and that's Google, the internet giant, which is nearly 1 trillion market cap. So Facebook is definitely a large cap stock at this point, and they expect enormous growth potential. It's just not going to happen, but it's definitely a big, large company, and the reason is because it's found a way to monetize its platform, whereas Twitter, they've struggled with their ad networks, and you can see why they're just still at a 23 billion market cap, which is nothing compared to Facebook's 650 billion. And then when we look at the short interest, though, Twitter, 4.3% of their shares outstanding are being sold short, meaning people are betting against the stock. For Facebook, just 1%. Match, the matchmaking company, they run dating sites online, 14.5% short, only a 30 billion market cap. So you can see that that company, while their business model has worked in the past, they're really threatened by all the different social media platforms that gives people different places to interact. And then with the price to earnings ratio on the end here, we like to just have a perspective, basically looking at the mean for the industry, for the companies that it works in, just 37.2 times. And you can see many of these companies don't even have a price to earnings ratio, so it doesn't impact it. But Match is extremely high, Tencent is high, and then Alphabet is around 30 times, and then Twitter is just 18.5 times earnings. So Facebook at 31 times earnings, it's fully valued. It's not, we wouldn't expect that price to get any higher, but they are definitely pricing in a premium here for growth, for it being a social media stock. Now, the total revenues, 3-year compound average annual growth rate, and net income, Facebook's kicking butt. And we saw this on the chart, but they're at 34.3% revenue growth on average over the last 3 years and 22% net income. That's the bottom line, growing at an average rate of 22% per year. The crazy thing is that that's still below the mean of 30%, mainly because we look at Match there at 45%. There's only 3 companies, Tencent and Alphabet, and Twitter hasn't been profitable for 3 years to have that earnings growth rate. But Facebook is really hitting it hard on the revenue side at 34.3%. It's the highest of these companies, and that trickles into stronger net income. So I like what I'm seeing with the high revenue growth, and they've really found a model that works with monetizing their content, and I think that's going to drive even stronger net income growth in the coming years. Now, dividend yield, we just put this on there to give you an idea, but these social media companies are mainly focused on growth still at this point, even with Facebook and Google being large market cap stocks. They continue to focus on growth instead of income, so there's really nothing to say here for the dividend yield. Now, when it comes to the sentiment, I always look at what the analyst rating is for the stock. This is how Wall Street views it, and I use the S&P Capital IQ information, and they're showing that out of 46 analysts that cover the stock, it's rated at 1.55, an outperform, basically a solid buy here. A 1 is an extreme buy, a 5 is an extreme sell. So it's definitely screaming a strong sentiment reading here when we take a look at how the Wall Street views the stock. Now let's flip over to the price chart, my favorite part, and break down the key levels to watch and also take another look at sentiment based on the 200-day moving average. I like to start with this extremely wide view of the chart here just to give you an idea of what Facebook's done, what they've overcome. They were just a $20 price stock back in 2012. Now they're at $220. So this is an extremely big run for the stock. Even though it's 8 years, this is still a massive run. And when you look at the uptrend, it's still intact. Even after all the volatility that we've gone through over the last couple of years, the pandemic, everything that's just happening in the world and the economy, we can see that there's this strong support line way down here around 150. But the clear indication here is that it broke above the longer term resistance level to get it above a $220 share price. and new highs is always bullish for a stock, so that was great to see for the company. Now when we zoom in and we take a look at these shorter term key levels, we have a rising resistance line connecting these peaks here, so that's going to be a clear resistance area as Facebook continues to climb. And then we have the short term support area. Now with Facebook climbing back above this key area of resistance, that's our first short-term indicator that we want to see Facebook hold above. This area around $225 a share. That could be our extreme indicator here for just keeping Facebook on an uptrend and continuing higher. But if it breaks below that, I'm not overly concerned, because then we have this support area to keep an eye on. Now this area looks like the new short-term uptrend that it's in, that it's creating, and we would like it to see it hold this level. If it falls below that, the next key level that we have that can kind of help out is this 200-day moving average. It's sitting around $200 a share right now, but these are the three main areas of support to keep an eye on. The resistance here is not much. Again, they set new highs, so we're excited to see the stock continue to climb higher. If it could just get through this boycott in July with some more strong demand for ads, and they were able to post some new nice comments about seeing an influx in demand, then I think that's going to help send them up to $240 a share in no time and even higher. So this is a stock that has a lot going for it. So now let's run through my checklist. We looked at the fundamentals for Facebook, and the revenues and net income were in solid uptrends. So I expect that to continue. We're seeing strong demand on the fundamental side. They've been able to get it done in the years past, and now they've overcome the hump. Strong income on the bottom line, and I think we'll see that continue. So fundamentals get a check mark. For sentiment, Wall Street's bullish on the stock. They have it rated as an outperform. The stock's above its 200-day moving average, the yellow line on the chart. So I believe that this stock has a check mark for the sentiment. And then the price chart, we just looked at the key levels, and with only one clear resistance, that's a rising resistance, meaning that Facebook's going to have to move up even higher to hit it. I think we're seeing Facebook in a strong position here to continue heading higher. So it gets a check mark for the technicals, and that means one thing. With 3 check marks on the board, this is a bank it stock. Now, if Facebook's a bank it stock, we can dive back into the price chart to figure out where we expect shares to head over the next 12 months. And since we've already broken everything down, we know that the key levels we want to watch are these shorter term, the rising resistance line, and then this shorter term uptrend. So I think that we can see a little bit of a pullback here. The stock's trading around $230 a share today. So we can see a little bit of a pullback. Maybe it holds support here. Maybe it dips a little lower, and this is the ultimate support level. But once it starts to trend higher, I think it'll eventually get back up to this resistance level, maybe around 245 or 250, where it'll meet that. And then we'll break out higher from that. So I see the stock heading to $270 a share over the next 12 months. It's just a 20% rise. But again, it may dip a little lower. Ultimately, this is where I see the stock headed. And in a volatile market like this, it's important to find the stocks that you can bank on and trust going higher. And Facebook's one of those. So that's all for my video today. If you enjoyed it, just be sure to give it a thumbs up to let me know that you liked it. Remember to subscribe, and be sure to leave me a comment. Let me know what stocks you want me to break down in my next Bank It or Tank It. So until next time, I'm Chad Shoup.